Yes, want to welcome. I invite you in a 30-minute session. We'll be discussing something of great importance, this YouTube channel. The name of the YouTube channel remains Accountant Ken. This is a channel that we use to make even, we streamline and we post different lessons relating to accounting, relating to day business matters. When I talk of business matters, I talk of inflationary periods, I talk of the periods where we discuss even the state of the budget, how what exactly does budgeting means, and all those. But for today, allow me bring you one of the statements that are prepared at end of every year, but uh, are essential and it is a requirement. Among the statements is the income statement. Remember, most firms prepare three of the statement. That is the income statement, the balance sheet, and the cash flow statement. But now we want to major on the income statement. How is income statement prepared? And before that, what is income statement? May I say that an income statement is formed by combining the trading and the profit and loss account. We combine the trading account and the profit and loss account. What do I mean? When you talk of trading account, it starts from the sales to the gross profit. That is where we put a full stop when trading account is concerned. But all the other information that follows from the gross profit is information that relate to profit and loss account. Let me say that the trading account is prepared to find the gross profit. Whenever you hear of a trading account, it is account that we want to know what exactly is the gross profit that a company have made. When I say gross profit, you should know that it's a profit that it's nothing much that I've done to it, so we can't tell what exactly is net profit or net loss. And when we talk of the profit and loss account, we talk of the account that ascertains whether the business have made a net loss or the aggregate loss or the aggregate or net profit. Uh, Many accountants or many firms adopt several formats, but the most standard or the format that we'll be following today on preparation of an income statement is the vertical format. In vertical format, this is a format that starts, first of all, you should show the name, the name, the name of the firm. Then you indicate it is the income statement for the period. Every question should show the period in which that business it's related to or it is operating. So I've not just shown because they will have a question and the solution of the same after this. Let me say that this is the format. We start with the sales. You will start with the sales. Then we indicate we have the first, maybe you are using Kenyan shilling, Kenyan shilling, Kenyan shilling. You just prepare as I've just shown you in this example. You start with the sales. You indicate the sales here and not here. I've said it's not here because this sales, you can place it here if you don't have any expense or any expense related with that sales. But after you indicated the sales, there is you less sales returns. When you talk of sales returns, maybe I've sold 10 pieces of I've sold 10 laptops, maybe in wholesale, and after selling, the one who have requested them, he or she have just requested that packet. But after I've sold them, take an example, each laptop costs 10,000. So 10 laptops, it's 100 shillings. So I will come and reckon 100,000. I've said each laptop to cost 10,000. So 100 laptop or 10 laptops will be a total of 100,000. So I reckon 100,000 here. But you realize after maybe I've made the sale, I've initiated the sale, or I've maybe closed the sale, the one that I sold to, I've realized that 2 of the laptops are faulty or they have some mechanical problems, and he or she have decided to bring it back to me, or me now as a supplier, or bring it back to me. So what will I do? I will less sales returns. Maybe I've returned 2 laptops, so I will less the cost of 2. That is 20,000. So assuming it was 100,000, I will less 20,000. So that's why we have said you less sales returns or return in ones. These are goods that we had sold, but they have been returned to us. From there, we get what we call net sale, and we record it here because it's final. It is a sale less sales return, we get net sale. I think we're together up to that point. From there is the cost that we less. It is called the cost of sales. Cost of sales is the cost that is related to that sale. And before that, or under the cost of sale, we have the opening stock. We have the opening stock. And when we talk of stock or the opening stock of this financial year is the closing stock of previous year. So we start by opening stock. Then we had purchases. So for example, we have our stock worthy, let's say example as they have given of laptops, 10,000. So maybe we have our stock that we had, maybe we had 5 laptops. So that will be opening stock. Then we decide now to hand our stock. That is, we hand purchases. We'll go hand purchases. So we will hand purchases. And these purchases, we reckon them here. Why? Because they are costs that are associated with the purchases that we should account for before we hand them to the opening stock. And those costs are current in ones. We have purchased goods. Remember, we have purchased. We are the ones who should incur that cost. That is the cost of bringing them to our business. That is the cost we call the carriage in ones. May I give an example? You've purchased maybe firewood. Maybe you have booked and purchased 1 lorry of firewood. And that lorry is worthy 4,000. So that is the purchase. But now there is the carriage in one. You want to bring those firewood to the business, to the premise or to the business. So the lorry, take an example, it will charge you 2,000. So that 2,000, you should hand it. That's why you'll hand some people saying, this shoe of mine is worth 2,500 or 2,500. Yet, the original cost was 2,000. Those people are not wrong. No. Because they incurred costs when they were going to take the shoe. So, when they tell you it is worth 2,500, they are never wrong. That is what we call the carriage inward. Then you should earn wages. Remember, you've paid for the transport. In case you cannot do the other, maybe the labor by yourself, maybe this labor is associated with offloading. There is loading and offloading. And when you talk of offloading, it is because now the goods have been delivered to your farm, and now you want to offload them. Maybe you incur some wages, so it is not necessarily this to be there, but in case it should be recorded as wages and it should be handed. So total of these purchases, you hand carrying ones, you hand wages, you get this amount. This amount here, that is what is associated with what you've bought, or that is what is associated with the purchases. But remember, as we said, whenever we sell, the people that we sold to can return some goods to us. The same happens when we purchase and realize that some goods are faulty or they are not in good condition. We decide to return them back to anyone who sold to us, and that we say it is return outward. Why is it outward? We are returning it from our business to the seller or the one that sold them to us, and we less. After you less, the amount you get here, you indicate it here. So the opening stock plus all these costs associated with the purchases from the purchases, you hand. Then you get what we call goods available for sale. These are now goods that are available for sale, or the goods that are ready to be sold. But before you do anything with the goods available for sale, you less closing stock. Remember, it is now approaching maybe 31st December 2007, and we are closing our books, and you realized maybe you bought some laptop for the sale, but it have happened that you've not sold everything. What do? You can't, you account for. You note that there is stock that is remaining unsold. Considered it is in good condition, that it will be opening. This closing stock will be opening stock in the next financial year. So you less the closing stock. After you less the closing stock, now whatever you get here, it is the cost of sales. Now the real cost of sales. Where are we saying the cost of sales? Whatever we are selling, it is related to a given cost, and this is the cost of sale. You record it here. After that, you see the net sales and the cost of sales. When you subtract these sales, you subtract the cost of sales. Whatever you get here, if you get a positive value, that you refer it as gross profit. But when you get a negative value, you refer it to as gross loss. Why am I talking of negative and positive value? Whenever cost of sales, I want to make this point clear. Whenever cost of sales exceeds the sales itself, that is directly a gross loss. That is like you have incurred more in producing a given product. That means automatically you've made a loss. But when the sales, your sales exceeds the cost, that is when we talk of the gross profit. I think that point is at home. From there, that is why I said we want to prepare an income statement, and it is formed by combining the trading account and P&L. Why am I saying this? From this point, if the question and asked you to prepare the trading account, you will end at this point where you have the gross profit. But if the question is requiring to prepare an income statement, now you will proceed. You'll hand the trading account with the P&L, or the profit and loss account. And we say the main function of P&L it shows us the net, what we call the net profit or the net loss. Left hand. Now after you get the gross profit, you had other incomes. These are the incomes that maybe they are not directly related to what you are trading or the business. For example, the rent receivable, the rent income. They are not related, but you received. They are the interest received. Maybe you have bought some goods with interest, or you've received some interest. So those are incomes. So what you do, you earn other incomes, you earn the rent receivable, you earn the interest received. After you earn this one, you earn them with the gross profit. What you get here is what we refer to as gross income. You can see we have earned gross profit with the other incomes. Now we get the gross income. Now this is our value, that is the gross income. From there, you have to less expenses. Remember this sale, we have incurred some expenses. So you less these expenses. So we continue. I was saying that this becomes now the end of the trading account. Now we continue. After now we get the gross income, we less the expenses. That is the operating expenses. These are the expenses that are related to these sales. There is like the discount allowance. When we talk of discount allowance, remember maybe we have sold something to our customer on discount. For example, we are selling each laptop at 10,000. We decided to extend a discount that whenever you purchase a given number of laptops, maybe 20 of them will give you a discount. And for that reason, anything that we sell on discount, we less. It is an expense that we've incurred. So you less discount allowance. We record it here. We have depreciation. When we talk of depreciation, depreciation means loss in value. And what is it that loses value? This is automatically the fixed asset. When you talk of fixed asset losing value, it is due or because of or the reasons behind it, wear and tear, and some other reasons. For example, you purchase a new motorbike. There is likelihood like after 2 years, it will lose some value. And after losing those the value, you realize we have what we call the depreciation, or it will lose its value. And after losing value, that is when we talk of depreciation. We talk of depreciation. And now, so I was saying, you less the expenses, the discount allowance, the depreciation, that is, I was saying the fixed asset loses value because of wear and tear. And due to that, you provide or you have the depreciation. For example, there is several or different methods of calculating depreciation. I'll give you just 30 seconds to tell me those methods. Yes, you are right. One is straight line method. Two is we have the straight line method. That is the most. We have the reducing balance. All those are the methods of calculating the depreciation. Another thing now, we less the provision for bank and doubtful debt. Remember, in every business, there are people that we call them maybe they are defaulters. There are people that are not they are not good in paying our debt. So those people, whenever we give them some loans, they fail to pay, and at the end of it all, there's no need of each and every accounting period. You account, yet you have ascertained that these loans are not likely to be paid. So what you do, you have provision for those doubtful debts, the debts that are likely not to be paid. Then you have the outstanding expenses, the prepaid income, transport, rent, and salaries. Even salaries, those are expenses that are deducted from the after you get the gross income. So after you get all those expenses, you hand all those expenses, you get what we call total expenses. These are, you record them here, the total expenses. Now that we have the gross income and total expenses, what do you need to get the gross profit? We automatically do the same. We subtract gross to get net profit. It is gross income minus total expenses. Whatever you get here is what we refer to as the net profit, and this is the final in as much as the income statement is concerned. But my question is, what if you get the total expenses exceeds the gross income? That is when you get something we call gross loss. What do I mean? In a business, it's not necessary that to get a net profit. No. Some businesses close with a terrible loss, and that is what we call the net profit. But I want you to note that as I said earlier, how the income statement is prepared, it is a combination of a trading account and P&L account. So by so doing, you are good to prepare your income statement. So I just have a question done for you so that you can know what exactly I was meaning when I was analyzing all this. I want to present you a question. So let's continue. I want to have us now to have a practical example. This is the example 1. And if I were you, I could be maybe writing this example so that as I will be doing it practically, you also do it. The question reads, the information below relates to books of Ivan Traders. I've underlined the name Ivan Traders. I've said the book relates to Ivan Traders for the period ending 31st December 2002. Where have I analyzed those? I'll just tell you why I've underlined Ivan Traders and that 1st December 2002, and there is something else that I'll underline. So, the information below relates to books of Ivan Traders for the period ending 31st December 2002. So these are general information that relate to this book, to books of this trader named Ivan Traders for the period ending 31st December 2002. These are very important things to note. We have the details and the Kenyan shillings. We have the sales of 450,000, purchases of 350,000, opening stock of 250,000, purchase returns of that 5,000, sales returns that 5,000, closing stock 350,000, depreciation 7,500, carriage in ones 15,000, carriage out ones, carriage in ones of 5,000, carriage out ones of 15,000. We have discount, carriage out ones of that 5,000, discount received. No, discount received that 5,000 and discount allowed for 5,000. This is what I mean. Sales of 450,000, purchases of 350,000, opening stock 250,000, purchase returns that 5,000, sales returns that 5,000, opening stock 350,000, depreciation 7,500, carriage in ones 5,000, carriage out ones 15,000, discount received that 5,000 and discount allowed 45,000. So the question is required. Prepare a trending profit and loss account. This is another name for the income statement. Another name of income statement is trading profit and loss account. Why is this name? Where does this name emanate, or where does this name come from? I said an income statement is a combination of trading account and profit and loss account. That is why you'll see some books telling you or requesting you to prepare an income statement, while some other books requires you to prepare trading profit and loss account. And some other books can as well ask you to prepare the statement of financial position, something to do with that. So this is now another thing that I've prepared for Ivan traders. So I'll just give you 1 minute. As you prepare yours, I take you through. So we're in the solution part. The question was the information below relates to the books of Ivan traders for the period ending 31st December 2002. May say that now in the preparation of an income statement, you have to start with the name of the business. And the name of the business in our case is Ivan Traders. Then the second thing that you have to indicate is what are you preparing? It is the trading profit and loss account. But I can advise in this, just indicate exactly what the question is asking. If the question is asking you to prepare an income statement, it is one and the same. But show Ivan Traders income statement for the period. That's why I send I send for the period. For the period ending. Now this is for the period ending 31st December 2002. So I said we start with the sales. And I said you indicate sales here. Our sales was 450,000. As you can see, it is 450,000. You indicate our sales here. Then we less return inwards. Our return inwards was that 5,000. So with your calculator, you can say 450,000 minus that 5,000, you get 415,000. You indicate it here. Now after you get this, it is what we refer to as the net sale. This is a net sale. Because why is it net sale? It is because we have subtracted the return in ones from the original sales. That is, now we have what we can call net sales of 415,000. I think you can see it clearly. 415,000. From there, I said we less cost of sales. This is cost that is related to this sale. And from our question, we had opening stock. Where is the opening stock? It was 250,000. So here we'll indicate opening stock of 250,000. But I said something. After we indicate the opening stock, I talked about purchases. You hand purchases, and in our question, we had purchases of 350,000. So we had this 350,000 here in this column. Why is it here? I said it is, if there was nothing like carriage in one, we could add it directly here. But for our case, we have, in our question, we have carriage inward of 5,000, as you can see. Carriage inward of 5,000. So So you earn carriage inward of 5,000, and that's why you get 350,000 plus 5,000. It is 355,000. From there, I send. We have ULEZ, what we call purchases returns. Purchases returns. These are goods that we had bought, but because of maybe they are not meeting the condition, or they are not in good condition, we decide to return them to the suppliers. And we can say we have. You look in our question. Do we have any carriage inwards? No. The purchases returns. Do we have any purchases returns? As you can see, we have purchases returns. We return goods worth that 5,000. So we less here in our question, in our solution, we less that 5,000. After we less that 5,000 from 350,000, 55,000, we get 320,000. Now this 320,000 is what we refer to as the net purchases. These are the net purchases. And as I said, now you hand the opening stock plus the purchases having less carriage inwards and having added carriage inwards and you less purchases. This total here, you had it with the opening stock, 250,000 plus 320,000. We get 570,000. 570,000 we refer it to as goods available for sale. Now these are goods that we have for sale. And as I said, the opening stock here, the one that we are adding, the opening stock, this was the closing stock of the previous year. And now because we have our question is for the year ending that 1st December 2002, the opening stock here was the closing stock in the year ending that 1st December 2001. So after we get the goods available for sale, we less the closing stock. Why are we lessing the closing stock? As I said here, I said we less closing stock from the goods available for sale. Why are we lessing the closing stock? We less the closing stock simply because it is now eating us that it is 31st December 2002. Yet, we had expectations that we will sell goods worth 570,000. That was our expectations, maybe according to our selling experience, that we were to sell goods worth 570,000. But this was never, it never happened as we planned. So we realized as we are closing the books, we have some goods unsold, and that is the closing stock of 350,000. So what do we do with 350,000? Yet the owner of the business wants his books prepared. We will just less the closing stock of 350,000, and when you less 350,000 from 570,000, you get 220,000. And this is now what we refer to as the cost of sales. I think that point is at home. The cost of sales, this is a cost that is associated with the sales that we've made. And this is now the cost of sales, 220,000. From there, I said, now we have the cost of sales and we have the net sales. What we do, we subtract the cost of sales from the net sale. We subtract 415,000 minus 220,000. From my side, I see 195,000. And this is what we refer to as gross profit, having subtracted the cost of sales from the net sales. And may I make this point clear? It's not necessary that a business should make the net profit at the end of trading in case the cost of sales exceeds the net sale. We get what we call gross loss. Now, because we have a gross profit, this is now the head of the trading account. But our question asks us about trading profit and loss account, or rather an income statement. That's why I said in this case we have some other things to add and to subtract, and we start with things that we should add, and among those things are the other incomes, or the other things that we are adding here is the other income that the business realizes in the process of its trading period. And we have these like the discount received. In our question, we had discount received. That means we received some discount. Where does discount received come from? These are discount we receive maybe after buying goods in bulk, or buying a lot of goods, or maybe the owner of the business decide that whenever we buy this quantity of goods, he will have allowed us some discount. And why are we supposed to record it as a discount received, but not the actual cost of a product? Let me bring it in simple question, in simple language. For example, laptop costs 20,000. That is its actual cost. But why in books of account should we record laptop cost 20,000, yet we received a discount of 500? This is because the actual value or the book value of that laptop, when you decide to go and get it from any other shop which does not have a discount, it is 20,000. Now, because we are buying from a shop or from a supplier who is allowing us some discount, that's why we should record it as discount received. We are here now. We had discount received. Now, because I said you can have interest received, rent received, discount received. Since we have, I said in this part you can have rent received, interest received, discount received, anything received. But now in our question, you can see we have only discount received. So what we do with this discount received, we add directly to the gross profit, and this gives us what we call gross income. We add that 5,000 to 195,000, and we get 230 as gross income. I think to this point we are together. Now we are not dealing now with the gross profit. We have graduated to gross income. Why? It is because we have added the discount received. From there, I said you less the expenses. That is the operating expenses. These are expenses that in one way or the other relate. You can't avoid them in the process of this business. So I said that discount allowed, depreciation, provisions, salaries. But now you don't measure to record all this. You just concentrate on what is asked in our question. Our question have only one allowable, or the one expense that we ourselves we allowed. I want you to understand these terms. When we talk of discount received, this is discount that we ourselves received from the maybe suppliers. But when we talk of discount allowed, this is a business, and whenever we are selling, we can also opt to allow some discount to our customers, and this discount is what we call discount allowed. And discount allowed, we have it here. After now that we have I've said this is a gross income. So we have some those expenses. So I said among the expenses I've just mentioned, the discount allowed, depreciation, provision. So we check in our question. Our question is we have sales, we have used sales, purchases, opening stock, purchases returns. I've said we have used, yes, we have used purchases returns, sales returns, we have used the sales returns, closing stock, we have used the closing stock. We have depreciation, this is an expense. And I said depreciation comes from loss of value of the fixed asset. When a fixed asset loses value because of several reasons that you know, like wear and tear, we have to bring something we call to account its depreciation using any other method that you know about, like straight line method, among other methods. So you less depreciation. We have depreciation of 7,500. You less it here. Depreciation of 7,500. We have carriage outwards. Why is carriage outward an expense? Carriage outwards, this is expense relating to carrying ourselves to the respective customers. Maybe we have sold a laptop. We are like, let's say example, we are carrying this laptop or this laptop from Nairobi to Nakuru. So there are some expenses that we can decide or we have incurred in carrying this the product. So this is what we call the carriage outwards. In our question, we have carriage outwards of, as you can see very well, carriage outwards of 15,000. So you subtract, you add it in this list of expenses. We have 7,500 for depreciation, carriage outwards 15,000, and we decided now, as I've said, to allow some discount. And this discount, it is discount allowed. We decided to allow a discount allowed. We decided to allow a discount of 45,000. So you have it there in the list of expenses. And this total, 7,500 plus 15,000 plus 45,000, it gives us a total of 67,500. And these 67,500, these are expenses. So whenever now we subtract these total expenses from the gross income, we subtract. What we get is the final, and this is what we wanted. This is why we close when the income statement is concerned. When you see we have the gross income of 230,000, you subtract this expense of 67,000, you get 162,500. And this is what we refer to as the net profit. And someone is asking, what could we do, or how could we reckon this in case we had these expenses exceeding? For example, if we had expenses of 267,500, automatically when expenses exceed income, we have something we call net loss. But for our case, the gross income is higher than the expenses. So we get this value 162,500, and you are allowed to underline to show that that's where your statement ends. So I want to welcome you. In upcoming classes, we'll be looking or we'll be going through the other statement. Today we have just discussed the income statement. I hope it is well understood. Maybe some other time I can bring a question to revise on the same. But when you follow up very well, I think it is well explained. Next lesson, I'm expecting us to have the balance sheet, and if time allows, we'll continue doing revision or teaching, training, or getting ourselves. We interact with all the statement of financial position because these are very crucial and important statement in as much as accounting and business is concerned. Thank you very much. Remember, the YouTube name remains Accountant Ken. Go subscribe, like, share, and comment. Why comment? Simply because we can know what to improve on, what to hand, what to bring, and I'll be there, and we will be there with my group following to see what we improve and which areas we are smart and which areas we should improve on. Thank you very much. Meet next class. Thank you.